Yeah.
My position on this stuff moving forward is that I will always write 2 notes.
Yep.
And I want to write my first note at the lowest dollar amount I physically can write it at, that puts me in a position that I'm comfortable with from a cash position, right?
Gotcha.
So if I can write it at 52 cents on the dollar, if I can write if I sell it for $100,000 and I can afford to write it at $52,000, I'm going to write the first lien at $52,000 because that's just going to be a lot better for everybody involved. And plus, I get to stay in some of that deal as well in a junior lien position in the second note. And then I don't have to worry about as much on how somebody's going to be able to come in and, take that away. And most people
let me clarify, first and second liens has nothing to do with how much money the lien is worth. A first lien can be 20 and the second be 200. It's the order of the county records of recording, right?
Great
Not
point.
just jump over it first, second.
In fact, we're seeing a lot of first notes being smaller value than the second notes now because of the equity position that's happened because values on properties have gone up.
Yeah,
right. So the cost basis may only be $100,000. The property's worth $300 now. Well, I only need to clear $100,000 of debt, and I'm okay staying in the deal for the cash flow by doing it the other way. So
if you're part of, if you're part of Nick's group and stuff like that, and you're looking for people to buy notes, pick our brain, reach out to us, right?
Please do.
Yeah, we'll buy it, right? If it goes
buy 'em.
non-performing, you get really scared, we'll come and save the day for you, right? That's what we did for years.
Yeah, don't call me on the non-performing. Call Dave and Nathan, man.
We're very interested in
Yeah.
non-performing. Absolutely.
Right. And if you're looking at partials, which we didn't get into this call, it's another option to do. We've had webinars on partials. We probably should do another one again soon. But partial is another way to get some of your money out. It's similar to 80-20. I'd rather you do an 80-20 than do a partial, but you can do that whole facet. I'd rather buy the whole loan than actually buy a partial, but I can make both work. Nathan's trying to figure out how he can make it work on his side. So
Yeah.
Nick, for your experience, these people getting in, what are some of the big mistakes as we're closing up here that people are making with either originating or selling a note?
Well, I think on the origination side, I think they really need to understand you need to work it from the end backwards. Okay. So even if you don't intend to sell a note, you probably need to structure it and look at it as if in the event that you do. Okay.
Right.
This is on the creating side, right? So you want to make sure you do it so you don't have to go have a fire sale and end up having to scratch a check to get out of the deal. That's number one. So you want to know, like, what would somebody, what would the indicative bid be on the note if it's created this way and it's underwritten from the RMLO and everything's stacked correctly. You need to know what the market will bear if you're going to create. That's my opinion. Okay. On the note buying side, it gets back to, what's your propensity for risk? Okay. Because everybody has a different definition of risk. And some people, and a lot of people have a different opinion on what a solid return is. Okay.
Yeah.
Right. Because if you're a family office and you're sitting on $100 million, you're not trying to make 12% return on your money.
No.
Right. You're trying to preserve your $100 million and you're trying to get a solid return that outperforms inflation. That's what you're doing. So you want higher quality stuff. So it's really just, you have to understand really where you want to be in this and what, I'm older. I have a lot less chances to go back and fix do something over and over again. If I was 25 years old or something, I may have a different opinion on how to structure this stuff out, right? I might be a little bit more willing to take risk, take something that's a little bit on the edge of being a reperforming, non-performing judicial state note because I can get it at a thing. And I don't really care if I got to take it back because that's what I think is cool. And I'm happy to do that. I don't want to do that anymore. So I think those are the things. I don't know if that answered your question, but you just need to really need to whiteboard this out and think it through and not just say, hey, oh, that looks like a good note to go buy because I'm going to get a 10% return and it's down the street from where I live. Because if you live in Chicago and it's down the street, that might not be the best place to be investing in a note.
Yeah.
Because it's all relative. So anyway.
Before Nathan, you asked your final question. Drew, I wanted to comment your question about creating mobile home things and as different family homes, I suggest you reach out to Max, call the underwriter, go directly. You can Google it and you get information about Max. I reach out to him directly, ask him what specifically you would need for mobile homes and whatnot. And someone asked also, can we price out a note that you want to hold for 12 months and whatnot? You know, you want to create this month and you want to know what we pay a year from now. I can do the math on that, but don't hold me to the quote of my price, right? Because if it
let's look at it. Let's compare
Yeah.
apples to apples. Okay. What's the difference between a new note and 12-month season note? Let's in all things equal. How much is it? Another 2 points, 4 points, 6 points?
For me, it's 2 points.
Yeah,
Like
it's
2
not gonna
points?
be a huge difference. Yeah.
So this is a great question here because
Yes, we should have asked this earlier. I know we're losing people here, but
Yeah.
if it's
because here, let's
table
talk about this
funding-
because my position is, you got to ask yourself the question, is the upside gain worth the downside risk? Okay.
Yes.
So if I hold it for 12 months, and there might be some tax advantages of doing that, but that's beside the point. I can get an extra 2 points. So in that situation, if it's $100,000 value, I might be able to get an extra $2,000 according to you, Dave, right?
Yes.
Let's just say that note doesn't perform in 12 months and it starts underperforming. Now, what's the value of that? How much, what's the deduction on that?
So it's a dramatic
A lot
discount,
more.
depending on the states and stuff like that.
It goes downhill a lot faster than it goes up. Do you
Yeah.
agree?
Yeah. Yeah,
Right.
absolutely.
It could drop 5, 7, maybe
Yeah.
10.
I may be targeting, say 15, but if it goes non-performing, I may be targeting 25. And the reason is I can't get inside the property. I can't see the condition of the property. Will the borrower file bankruptcy? What will happen? We can't predict. So my risk level goes up. So I got to aim higher for my returns, right?
Mhm.
And just to clarify what seasoning means, everyone considers seasoning different, right? Table funding is at the table, you double close an idea. Some people want 3 months, some people want 6, right? We're targeting around 3 months right now. Nathan will buy at the table, right?
All table. Yep.
Right? But if I bought the table, I'm going to increase it 2%. It's just what we do because the risk level, is this borrowing to continue performing? If not, I got to default and consider that. If they do perform, the risk level is still there, but I would like to make sure I'm covered.
Yeah.
So we could price that a loan a year from now, but we don't know where the note will be, nor will we know what returns we're going to want a year from now.
It may not be exact, but it'll give you a ballpark anyway.
Hey, what if CDs go to 14% a year?
Right.
Right? Why would I buy your note at say 15 when I get a guaranteed return in a matter of at 14? It's not about the fact that, well, CDs are 14, you could buy at 15. It makes sense. No, because there's still risk in our note space.
Yeah.
So if CDs are 14, I'm probably at 22. I'm a much higher number.
But the inverse applies. The inverse applies too. If it goes the other direction
I'm going
and
down.
the market starts tanking,
We're targeting 10% 3 years ago.
Yeah.
We were there because what the money was, where it was. So it's a matter of where can our capital go and what return we need on our capital. So I think that's all the questions we have on here. So Max, is Tennessee one of the low usury state? Max doesn't get involved with the usury law, right? That's something for you to do. He does the underwriting side of it, right?
But
The
yes,
usury
he
law is
underwrites
state-specific.
nationwide.
Yeah, he's nationwide kind of underwriting. So if you question about underwriting, that's Max. If it's a question about usury law, that's your local attorney or your originator in your state.
Yeah.
So
So-
Max doesn't originate. Max only underwrites.
He's just an underwriter. Call the underwriter. That's him.
Just so you guys know, just a quick point of clarification. We are doing full loan originations in 18 states,
Okay,
and we're adding more all the time. So to muddy the water a little bit,
Okay.
we will underwrite in all 50 states, and that's typically what we do. But because the demand has been so huge and continues to grow, we are offering full loan originations in 18 states.
are
and
you
hopefully-
an MLO in those
That's
states or?
Yes, me and an affiliate. So,
Okay.
So you
correct.
using it? You actually have an NMLS license to do that then?
Correct. Yes, sir.
Got it. So you are actually the lender of record on those transactions.
We would do an assignment at closing to the seller. Correct.
Gotcha.
Yep.
Fascinating. All right. Good to know.
Yeah. And we're adding more states all the time. So
So one question when you do that, then are you following traditional for you to do that, or does it have to check all the boxes as a traditional bank lender would have relative to the DTI credit score?
Well,
know.
they're understand that almost everything, 99% or better of all seller finance notes are non-QM. And so we're following standard non-QM origination and underwriting principles. So are they more flexible than Fannie and Freddie, who's selling to mortgage-backed securities that are very risk averse? Absolutely. These aren't QM loans. But with that said, they're still compliant, they're still legal. And so, yes, it's not the Wild West. We have a metric that we follow to make sure that you guys are safe with the paper that we're helping you generate. But thank God it's a lot more relaxed than what Fannie and Freddie lenders are having to go through, right? Which is why if you're under a 720 now, they just draw a line in the sand and they only pick their low hanging fruit and they leave the rest for seller finance.
So it's 720 now. It's up to 720 now. Wow,
Well, that seems to be, because think about it. I mean, if you were trying to meet the Wall Street mortgage-backed security, that's a pretty high bar. And so the easiest way to do it is just draw a line in the sand and don't even mess with anybody that won't easily fit over that bar every time.
nice.
So some people are asking some general questions. Be sure to reach out to Call the Underwriter, where he's licensed and all that good stuff. So I would definitely reach out to Max, give him a yell, whatever, go on the website. And we can
alltheunderwriter.com.
Yeah.
Yeah, and you can if you guys aren't in our Creative Dealmaker, join the Facebook group. That's probably the best place to start. And it's just creative. If you go to groups in Facebook, it's just under Creative Dealmaker, and you can probably put something in the show notes, Dave, or whatever.
Yeah, absolutely. We'll put in the YouTube channel and stuff.
And,
And Facebook.
Put it all in there, and you reach out to Eric and myself. And
we run this webinar, different topics every couple weeks, every 2 weeks or so. So yeah, connect with all of us. We're all connecting each other. We're gonna make each other's life a whole lot easier. Go ahead, Nathan. I'll let you go ahead.
Yeah, sure. So we've gone over time. So we like to kind of finish off with this and get your crystal ball. Where do you think the market's going? But we are over time. So let's try to keep it concise if we can, just for people listening in.
Nick, where do you see the market going in the next 6 months?
Well, I think from the ability to create opportunities for homeowners that can't get bank financing is only going to get bigger. The seller carry market's gone from 20 billion to almost 30 billion in a very short period of time. And the average dollar value of these seller carries are, these properties are over $250,000 now. It's not like back in the day when it was a bunch of crappy houses that a bank wouldn't produce financing on. So it's just an easier path for most to do, but it's also a dangerous path if you don't integrate best business practices and use a transaction coordinator that knows how to do this, an underwriter that knows how to do it, or a servicer. You can really get yourself into a pickle. I don't necessarily mean legally, but I'm talking about from a valuation standpoint, because it'll make a huge difference when people like Dave and Nathan and even ourselves go to look at purchasing that note.
Yeah, absolutely. And I agree. I think there's no slowing down of the seller finance.
No.
I think that we're going to see more and more and more of that.
Yeah.
So learn how
Remember
to
when things
so
go
you can
crazy?
sell off the mortgage.
Yes, we want to buy as much as you guys can produce. Let's put it that way,
Absolutely.
right? And Nick's doing it too.
But you want to buy quality stuff, right? You don't want to buy a bunch of crap.
Yeah, non-QM is something we don't get much involved with, just because it's spotty. But if it's a clean non-QM where it's like some stupid, we have no problem buying non-QM, which is non-qualified mortgages for those who don't know that.
And I probably buy more than Dave. I'm a little bit more risk tolerant, and I'll look at that kind of stuff as well.
Nice.
All right, we're gonna tune up to the from the social medias. We're gonna finish up with Nick. Appreciate you, Nick, jumping on, allowing everyone to connect with us and do everything we all do together. And hopefully we'll be doing more business with each other in the near future in 2023.
Awesome. Thanks, guys.
Awesome. Thanks a lot.